Let's move on to the GDP because people were saying, oh, see, we're in the middle of a recession. The things look bad. The first quarter GDP came in, actually declined 0.3%. And there's three different numbers. This was the advanced number.
Yes.
And I forget I know there's a final. Do they call it the one in the middle? The middle?
Preliminary? I forget.
I don't know what it's called.
But I know, there's three readings.
Three different numbers. It was 0.3%, which can change. A recession, this is the problem. Generally defined as 2 consecutive quarters of declined GDP. So people saying, see, things are getting bad, already down for the first quarter. But again, it's just something that you have to look at to understand that we're only halfway through. This can change, and let's talk about those numbers as well.
Yeah, and the thing we look at is, 2022 was, I'm going to say, our last technical recession. We'll kind of talk about why that is. But what happened in 22 is we did see 2 consecutive quarters of declining GDP as Q1 declined 1.4%. Q2, the advanced estimate showed that there was a decline of 0.9%. As we kind of talked about, things can change as these numbers come out. And by the time that we have now kind of analyzed that Q2 GDP from 2022, well, actually it shows there was a 0.3% gain in GDP. So you went from a negative 0.9 to a positive 0.3. No technical recession any longer. And I point out as well, it's like, oh my gosh, things are so bad. Are we going to be able to get through it? Well, 2022 got off to a bad start, but the year ended with a 2.1% growth rate. So things can turn quite quickly. And I think we could see something quite similar here where it's like, oh my gosh, Q1 was difficult. And again, being down 0.3% in my mind is not that bad. But things can turn where we end on a positive note. And I think that's very likely.
And we got some great data to back that up. Before we get to that, though, I do want to talk about, because we talked about the recession, what's really defined that. The National Bureau of Economic Research makes the official call on recession. And many times that doesn't happen right away. It takes some time for that to come out. And they use a much broader set of indicators. They're saying, in the 2 consecutive quarters of negative GDP is kind of like a rule of thumb.
Yeah.
It could be a problem, but it's not the indicator. And I want to say the real call of the recession comes like 6 to 12 months later. It takes them a while to do that because there's so many factors you have to look at.
Yeah, and I think if GDP, for whatever reason, slips again in Q2 and Q1 holds, but the labor market remains strong, I don't think they're going to call it a recession, especially, let's say Q1's down 0.3 and Q2's down 0.5%. And then I'm just pulling numbers out here. And the labor market, I don't think they're going to constitute that as a recession with such small declines and a positive labor market. But again, we'll have to see how that shakes out.
Some people in mainstream media, we're in a recession. Yeah, terrible. Let's talk about the government spending because it was, and I like this.
Well, we got to talk about the consumer spending first.
I'm sorry.
That was a big positive. I'll cover consumer spending if you talk about government spending.
Deal.
But consumer spending actually grew 1.8% in the quarter as services showed a nice increase of 2.4%. Also, private domestic investment, I was shocked by this, saw a surge of 21.9%. And this was led by investments in equipment as they grew 22.5% in the quarter. So consumer spending, one thing I want to pull out here is services up 2.4%. We kind of talked about this last week. Yeah. But you can't pull forward demand on services. I can't go get my hair cut twice in a month and then not go get it cut again.
Do anything, but you can do it if you want to.
You can't pull forward that. You can't go out to get a restaurant and pull forward that demand. Right. So to me, when I looked at services growing 2.4%, I saw that as still a big positive. And I do think on that private domestic investment, obviously that surge of 21.9%. I believe some of that is because of that pull forward in demand. I'm not going to say no way, very unlikely that companies are like, well, things are great, we're going to go spend this much money. I think they were trying to get ahead of tariffs, but still positive. Right. Companies aren't going to go get a bunch of equipment and invest money if they're like, oh my gosh, we're going to head into a terrible recession. They'd probably just cancel that spending rather than pull it forward.
Yeah, and I was so excited about this number about the government spending falling 1.4%, which does hurt the GDP. Yeah. But I still like it because the government is, it's from the taxpayers. That's where they get their money to spend. So to reduce the spending is a good thing. It was led by a decline of 5.1% spending in the federal government. So states, they're still doing different things, but I was glad to see the decline in that. And the group as a whole ended up subtracting about 0.25% from the headline GDP number. Not terrible, but still, I would be okay with a 1% decline in GDP if the government stopped spending and reduced their spending.
Again, you add back that 0.25% to the headline number. Now you're pretty much back to neutral. Yeah. But the big reason for the decline in GDP was trade. Companies were trying to get ahead of looming tariffs and imports surged. I was blown away by this. Imports were up 41.3% in Q1. That's a huge increase, especially when you compare it to an increase of just 1.8% for exports. And then the huge discrepancy caused the trade component of GDP, and this number is crazy. It caused the trade component of GDP to decrease the headline number by 4.83%. So you add that back in, now you're looking at GDP growing, actually about 5-ish%. I mean, it's just crazy. And again, a big component that domestic investment was an outlier, but the trade was an even bigger outlier to the negative side, and that really pulled the number down for GDP.
And when I saw that, remind me when you have inventory builds, it hurts the GDP, and the next time it helps the GDP. I think we're going to see that again, and I do not believe the second quarter is going to be a negative. I think it's going to be a positive because we're not going to see this. Again, 4.8% taken off of the GDP number. If that's just flat, that's going to be huge as opposed to reversal. So I was glad to see that number, and I thought it was going to be the high. I thought it was going to be high, but not that high. I was shocked on that. And then let's talk about the headline PCE showed an increase of 2.3%, which compares to last month's reading of 2.7%. And core PCE came in at just 2.6%. Inflation is really being controlled here. Nice decline from February's reading of 3%. I believe these numbers will likely increase with the tariffs, but they're not at high levels. And I heard the president call for reducing interest rates. I'm thinking, yeah, maybe that makes sense because I think we could have a little slowdown, and we got a good jobs market. We don't have inflation. Why shouldn't we take a quarter point off?
I mean, this inflation report kind of went under the radar, I think, because of everything else happening this week. But again, 2.6% is so close to that 2% target. I mean, it is not a concern. Inflation at 2.6%, I'm going to say, is not a concern from an economic standpoint. And as I said, I mean, maybe there is some credence to starting that lowering of the short-term rates from the Federal Reserve.